Welcome to Agency Acquisitions and Exits. I'm your host, Peter Lang, and today we're in our last installment of Creative Financing with the two Peters. Peter Baldwin has joined me again. This time, Peter, we're going to do it Q&A style. We have rapid fire questions from our Agency M&A Slack community and from our students, and they all kind of have to deal with creative financing. Ready to be put in the hot seat? We're both going to go through them.
Let's do it.
All right. Mark asked a question. This is a very important question, which is, if I've used an SBA loan to go acquire a company and I want to do more deals, what are my options?
There's a number of different ways to answer that question, but it's important to remember that, once you have SBA debt in place, your constraints become more defined, right? You've got DSCR requirements, that's debt service coverage ratio. You've got limitations on additional indebtedness or leverage. You have lender oversight, right? You are in a position where you have someone looking over your shoulder, and the great thing about SBA loans is, while they're great, they are also restrictive governance. And so you have to be focused on structuring around them. And there's a couple of different ways to do that, right? You can use corporate structure to navigate around that. You do have to be careful though, as to how you do that. You can also use capital structure. And we've talked previously about structure in general as how deals are done, right? Any new acquisition needs to fit within the SBA framework or be structured outside of it, right? So let's talk about both those things really quick. Structuring within that framework, you need to create an instrument that doesn't run afoul of the SBA's rules. That is a standby seller note that does not amortize for the entire life of the instrument. And that's a new rule by the SBA. They used to have a 2-year non-amortization period for those loans, but now it is the whole life of the SBA instrument. And so you need to think about, if I'm going to use a seller note, is the seller willing to wait 10 years to get paid? And these days, the answer is probably a little more no, because the way you used the standby seller note in the past was you used it as effectively like a quasi-equity instrument. The new rules need to make you think about it more like it is an equity instrument, right? It is a non-amortizing piece of debt that sits around for a long period of time. But now you can also have, that's for the equity credit piece. You can also have other debt that amortizes, but you've got to fit within your coverage ratios and your covenants and make sure that you're not running afoul of the SBA. And this is important, whether it's bank debt or SBA backed bank debt. You don't ever put in additional debt without socializing it with your first lien lender, because no matter how compliant you think it is, banks do not like surprises. And if you show up with a quarterly, covenant report that shows you got this other debt instrument there, they're going to raise their hand and say, "Pardon me, but what the heck is this?" That is not the way to manage a relationship with an SBA lender or a bank lender. They do not like surprises and will not reward you for them. The other way to do this is to literally structure your enterprise around it. That means potentially you drop an SPV in a different area of the organization.
Well, let's visualize that for
Let me
people.
pause for a second on that though, because I think it's also important to understand that when an SBA loan comes out, it's not just the borrower that is an obligor on the debt, right? It is usually any 20% plus shareholder. And sometimes they'll even look under 20% plus to see if you're trying to skirt the rules by having someone say hold 19.9% or 17 or 18 even. If you're not below like 15 as a real kind of comfort point, they're going to ask that person probably to sign a guarantee on the debt as well. Now, you can have your own sort of side agreements with that person, but odds are if that person is the seller, they're not going to be super happy about that, which is why you structured it as buyout in the first place and not as a big rollover equity component. Now, we talked in our last episode about preferred. One way to structure around that with an equity-like flavor for a seller in a rollover situation is to give them preferred, which doesn't necessarily incur that same kind of guarantee obligation. And then the other way you can do this is to make sure that you don't use an entity that is already an obligor. Now, we can talk about a host of different types of transactions we've dealt with, but it's not just those borrowers. It's the vehicle that the borrower owns that is also an obligor. So if I am, say, a 25% shareholder and I hold my stake through Baldwin Holdings, and Baldwin Holdings has an SPV that's a pure play in this specific space. It's called Baldwin Growth Holdings 1. Odds are in this particular situation, Baldwin Growth Holdings 1, Baldwin Holdings and Baldwin are all guarantors on that debt. So you can't necessarily incur debt at those entities either, depending on how your covenants are written. So maybe Baldwin needs to create another entity, and I'll still be the guarantor there, and I'm not prevented from incurring my own debt. But I'll still be the guarantor there, but I'll have a different entity outside of that capital structure that can be a borrower for my next acquisition. And potentially in a refinancing transaction, I find a way to combine those two things or set them up in a holdco or some kind of joint vehicle where I'm bringing all those assets together.
It's really important to double tap that. Now, we are proponents of creating corporate structures that allow us to do more M&A safely. And what you're describing is isolating the debt liability within an operating company and its ownership. And then creating a new tree to branch off your next investments, your next acquisitions. And the question we get asked is, what if those are in the same industries and businesses? Will the lenders care that you now have a sister company that is similar enough to the businesses that are being backed by that loan? The answer to that is yes, they would, but they don't care, because they care who's paying them. They care that you pay on time. But if you tell them that there's something available for them to add to that guarantor box, Peter, would they be against you adding it?
No, I mean, if it pencils out from a credit perspective, they're happy to have the credit enhancement and the diversification. The question is whether or not you want that and whether you can close the acquisition with it. That's the harder part,
Yep.
right? So the uncomfortable truth about
Yep.
roll-ups is they don't win by optimizing individual transactions. They win by not breaking the platform, right? As a roll-up buyer, you care about repeatability. You care about capital availability after the deal, your integration capacity, and your optionality for the next acquisition. If your structure can't survive several more transactions, it's not a roll-up structure. It's a one-off you're trying to bolt something into that you didn't design right in the first place.
Fantastic. Let's say that again. If the deal you did stopped you from doing future deals,
You broke the platform.
you broke the platform. You're not doing programmatic M&A. You won't be able to scale repeatedly and predictably by acquiring other businesses inorganically. Question on this. For those who currently run a business today and they have their first acquisition via an SBA loan, they bought out a competitor, and they still are active and they're trying to buy another business. You're telling me, Peter, I could just go and form a new holdco, a new shell company, new entity, new company, and go buy it in another vertical without having to even commingle all those business assets?
Yeah.
Yeah.
In fact, I would strongly encourage you to do so rather than commingling business assets, right? If you're acquiring in the
Yes.
same vertical, then you probably want to put them in the same general tree of ownership, right? But if you're acquiring in a different vertical, a different industry subsector or specialization, yeah, don't put them in the same bucket. I mean, that's all your eggs in the same bucket or basket, I guess, which is more appropriate for an Easter reference at this point.
Given the time of
Considering
year, yes.
we are recording the day after Easter. Um, it's important to know, like one-off buyers, it's a whole separate conversation about how this works. But if you're trying to build a platform, you should build a dedicated vehicle for that, and you should structure it with an eye towards your future acquisition. If you're just doing a one-off, then, first of all, I would ask, well, why, if you're not buying in your own vertical, you have to treat it like a separate business because it is,
Yes.
right? Doesn't mean you can't have a holding company out top or a personal, like a family office type structure that has that at the end of the day holds the equity, the ultimate equity of that asset. I mean, you and I both have our organization set up like that, where we have a super holdco that owns the equity interests we have in our various enterprises. But those individual enterprises are siloed into different capital stacks and different legal entity org structures. And it's imperative to keep it that way.
Yeah, going back to Mark's question, and this is one of the best things that we can provide as a sounding board for our community, which is, they've never built these things before. They've never built these type of organizations to isolate various degrees of risks and contingencies and compliances based upon how they're building their businesses. And what I shed light on the vast majority of the time is that there's folks like Peter Baldwin and myself who come from corporate finance, you much more in depth than I, who do this for a living, setting up corporations that allow you to do things like M&A productively. How common is this type of complex corporate structure?
It's standard.
It's not just getting an LLC and going out and buying someone with that one LLC owned by two partners and getting a loan on that business.
Again, I would suggest that it depends on what your goal here is. If your goal is to be a one-off buyer, then a single LLC is fine, right? For that one thing that you're buying. But if your goal is to create a programmatic M&A structure where you're going to create depth and breadth in an industry vertical, and you're going to be building your organization accordingly, you need to have a capital structure that is it's not just the actual financial capital stack, it's also the legal organization to create the proper insulation and structure for tax optimality, for capital access and for also for protecting the individual investments, right? You don't necessarily want to expose the acquisition risk of one to the acquisition risk of another, especially if you can hive off the risk in a single bankruptcy remote type structure. I used to work, when I worked in corporate restructuring, we did this sort of thing all the time where we used multiple legal entities in various levels of complexity to the point where I had some, small organizations that had like 4 or 5 companies. And, the biggest company I worked with had 352 across 6 continents, and you need to design for your specifics. And sometimes that's for tax purposes, or sometimes that's for capital access purposes. And sometimes it's for multiples of those. But you need to think about, how am I structuring this? And you need to have the resources and the team to help you do that in such a way that you are structuring to future proof as best as possible your investment, and make sure you are structuring with the end goal in mind, right? You always have to ask yourself, not just with capital, but with structures, what problem is this solving? And sometimes it's multiple problems. Stability during integration, it's flexibility during growth, it's optionality for future deals, it's protection against execution risk, it's insulation against tax exposure, it's any one of a number of things. And if you can't answer that question, then you need to figure out the answer, and that may require you to speak to an expert in the field. But you need to understand why you're doing what you're doing, and make sure you're doing it for the right reasons in ways that protect your investment and mitigate the risk. The actual capital and entity structuring is itself an exercise in risk management and mitigation and allocation of risk.
Yep. Relating this back to Mark's question, which is, Mark is a great illustration of this, has a holdco. He went out and bought a business. He has a partner in that business, and they're evaluating other acquisition targets. And we have his episode where he talked about working with the SBA, and they have this limitation on what they can do moving forward. And my favorite line for him is the same for people who want to go out and buy a company for the first time, which is financing, whether creative or traditional conventional or investors, follows a deal. If you go and find a company who wants to sell to you and your partner in the business you just bought, and they're motivated by you as individuals and being part of a network, they don't have to be owned by the same entity. And also your ability to fund that is going to be based on the opportunity. Far too many are trying to say, well, I need to go find or figure out how to structure this before I go do M&A and before I talk to people. No, money follows deals. Find the deal, find the seller, and you'll have a higher probability of putting that capital stack together.
And I would say further to that point, like if you find the asset you want to buy and you find a financing partner who is flexible and creative, they will help you solve the structuring questions, right? Whether it's your advisors or your lenders. Now, with your lenders, you got to be careful to make sure that bear in mind, they don't work for you, they work for the capital that's being lent to you. And that's one thing you should always, never get twisted.
They're incentivized to help you, but they don't work for you.
That is right. Their job is to put capital to work, and then their job, as soon as the capital leaves the front door of the bank and lands in your account, is to do everything they can to get the money back. Right? That's a little bit different than, say, a preferred or a common equity investor. While they're still focusing on that, they're also focused on other growth opportunities, and it's not just capital preservation, right? So lenders and equity investors, whether it's preferred or common, different risk tolerances, different investment profiles, different hot buttons, and ways you're going to focus on that. Now, you find the right partner and you answer the question, well, what capital and structure do I need? And the right equity will find, the right capital will find you.
Or there's plenty of people who will put in the effort to help you find it.
Yeah.
And so if we were to recap our solutions, if you already have an if you already have an loan in place, and you want to go out and continue to do M&A, you have several options. You have holdco structures that are outside of the borrower that you have defined for the SBA loan you have today. You have special purpose vehicles, so new entities you can form outside of that to go and do those transactions. You then can also create seller financed heavy deals, as long as it doesn't trigger any debt service coverage ratio constraints. And then you also have investors and equity partners in new entities in order for you to continue to reap the benefits of this deal flow. Keep in mind, equity investors inside of the SBA box has changed. So we always want to be sensitive to who you have on your cap table, as lenders are more than willing to add another person to fall on that knife if
They
you
absolutely
default.
the idea that you've got somebody else who's on the hook for the money that you owe them. They are perfectly
100%.
happy to have as many people in that bucket as possible who are on the hook to them. But
Uh,
if you can't just take out an SBA loan and think, okay, my financing capacity is shot, right? You've got financing capacity. You need to think about what your structure is in order to access it.
and continue to talk to sellers and communicate to them that's a real constraint. Sellers who want to sell to you will work within your constraints to get a deal done. So it's also an important fact. I want to get to Tristan's
Well,
question
I mean,
because he asks,
if they're a bona fide seller, right? If it's just a tire kicker, who's
yes,
asking for an unreasonable number because they've got this number circled in their head because they saw this one thing on the internet one time, well, that person may not be willing to work with you. But it is important to note that a constructive seller who believes in the deal thesis will find a way to get their money to pencil out in a way that they'll be happy with the terms. And it's not that hard to model returns to people if you can agree on on a basic set of assumptions that you can work for.
yep. We want your first deal to open the door to many deals,
It's
not
a
to create
capital
constraints on
allocation
future ones.
point, right? And a returns conversation.
Correct. Tristan in our group asks, how do you structure tuck-ins without killing future flexibility? Now, this was in the creative financing category.
Mm-hmm.
And let's give ourselves some rope on our assumptions here. We have an operating business. Maybe we've even done some M&A in the past, and we want to do some tuck-ins. So we want to absorb some smaller businesses, books of businesses, and some talent. What are some ways we can structure those deals that gives us the flexibility on the future performance of that business going sideways, going downward? Let's start with that.
Okay. Well, a lot of people revert to the notion of earnout. I'm not a huge fan about earnout in general. I think it tends to be a recipe for future conflict and oftentimes just kicks the can down the road. It invites a whole lot of debate and it keeps you on opposite sides of the table from a structuring perspective for far too long. One of the reasons why we talked about preferred equity in the last conversation is because I think it tends to align people better. It tends to act more equity-like and incentivize that behavior. And there's a whole bunch of ways to tweak that in ways that feel more like a debt instrument, in ways that feel more like an equity option for upside. That's really a question about how you socialize that with the actual seller and what they're looking for. And you can tweak it in a host of ways. I'm actually working on a little bit of a primer for this space to help orient people on a decision tree for how to structure private or preferred equity transactions in ways that are optimal for the desires and goals of both the buyer and seller. But beyond that, there can be there's holdbacks, deferred consideration, there's a portion of cash, there's a whole series of ways you can do this. If I assume one of Tristan's concerns is either I'm locked into something that I don't want, right, which is a future payment obligation,
to a
that is
business that's not performing, let's give it that's.
Yeah, I mean that's why people go to earnouts, right? It's usually it's the convenient way to avoid having a serious conversation about what happens when this business doesn't perform, because you don't want to say to the guy or the seller, pardon me, you don't want to say to the seller, what if your business falls down and dies, right?
Which,
Performance.
by the way, if you can't have that hard conversation, you're probably not going to be able to construct an earnout.
Agreed. Which is why I say, or you're going to be very sloppy in the definition and very broad, which invites future conflict, right? I mean, Peter, you know this as well as anyone, but earnouts are generally speaking the most common flashpoint in post-deal friction between buyer and seller. Right? There's a debate about, your performance, well, yeah, the business didn't perform, but it was under your control and you didn't define this set of parameters clearly enough. And so I'm concerned that this, or you changed the accounting policies and you started expensing this against the numbers, which is why we missed the earnout, or there's a whole series of ways in which those blow up. And it's not that they are, it's not that it's void. It's a tool. You need to have the hard conversation in structuring.
Let's get into that.
Not kick it down the road.
Yeah, let's get into that because that's a very important consideration. I remember a story of a gentleman who you and I both know who sold to WPP. And
Yep.
he famously explained to us his performance earnout. And he said, there was nothing in my agreement that says I couldn't move operating expenses to my personal credit card. And so he famously moved a significant amount of operating expenses to his personal credit card so he could hit the threshold. And Sir Martin Sorrell, changed some provisions in his future purchase agreements thanks to this transaction, because it can be done both directions.
Absolutely. And I mean, I've seen that as well, where somebody literally, they just didn't renew a bunch of services, and they think about it this way: if you're the seller and you have an earnout that pays you a multiple of EBITDA, well, every dollar I spend of my own on business expenses to ensure that I made that pays me back at whatever my exit multiple was. So if you think about it from an investment standpoint, if I'm getting a 5x on my $100,000 that I put on my personal credit card, that seems like a pretty good investment.
Yeah, it goes in both directions. So this is back to our point, which is
And to be clear, the conflict usually goes the other way, right? It's usually because the
the
seller
vast
knew
majority of the time. That's a sophisticated seller.
it's somebody who understood, right, very clearly and did it and was like, if I spend this money, then I get 5x that money or whatever.
Yes, yes. The point I'm trying to make is the detail you need to make a good earnout typically isn't what we see from folks who aren't sophisticated buyers. So unsophisticated buyers go to the market, want to use earnouts to bridge purchase price gap or valuation gap, and they are negligent. They are reckless in their capital stack and deal structures when it comes to things that are, earnouts or the treatments of future cash flows.
Rather than saying reckless, I would say they are, well, it may end up being reckless, but I'd say to a certain degree, they are
I
insufficiently
don't
experienced to understand that not being that precise is going to blow up on them, right?
Yeah, I don't think it's an ignorance debate. I have plenty of folks who have done deals, and then when I examine those deals, they don't pass the Peters test, where the level of detail required for the sophistication of their capital stack was not present.
Well, you can get out over your skis pretty quickly if you aren't well advised and don't have enough background and haven't seen enough deals to understand how each one of the instruments you're playing with can burn you. Now, I talk about, listen, I'm unabashed in my fondness for preferred as a structuring tool because it's a highly flexible contractual instrument, especially in an LLC context, because LLCs themselves are inherently creatures of contract and not creatures of law on the corporations. Captured in a contract, you can do pretty much whatever you damn well please with an LLC as long as both parties sign on the line that is dotted, right?
Yes.
But if you don't know what you're doing or you don't understand the full implications of the way you've structured the deal, you can lose a ton, right? I've seen people agree to participating preferred structures that in a sort of a mid-level returns exit eat up vast majorities of the equity value of the company in returns to the preferred holder, and the common holder who structured the deal is like, why did I bother?
Yeah. You need balance.
You need
You
balance.
you need balance.
Too much cost increases your risk. Too much variability reduces seller confidence. Too much imprecision in your drafting bites the buyer in the ass, to be blunt.
Yep. And you want meaningful seller participation. You want to make sure upside is present when you're using these structures.
Performance linked, right? You need to have it bona fide performance linked in a way that aligns the incentives of both parties. Because if you have a performance incentive where it's like, if we do well, if the company does well, you do great, and I get bupkis, that's a bad deal, right? That's an earnout where you didn't price it in such a way that the earnout funded itself, or a preferred equity structure where it overwhelmingly favors one party or versus another in scenarios. So you need to modify, or you need to model out like multiple exit scenarios and do the math and say, here's an illustrative. If this is how it is, right? In terms of our exit value is this, and here's how our capital stack looks. Here's what your return looks like. Here's what my return looks like. So both parties go in eyes wide open, because I swear, people tend on these earnouts and other things, they tend not to I don't know if it's just convenience or if it's that deal is running too quickly or they haven't taken enough time to actually do this. But if you can create those illustratives and then actually insert them into the deal doc, like here is the formula with multiple illustrative examples of how it would be calculated, then nobody can come back at you later and say, you didn't tell me that in this scenario that your participating preferred was going to eat up 40% of the capital, right? When you were supposed to get 20, right? Or you didn't tell me X, and now my earnout is half of what I expected it to be because you changed your accounting policies and this was the result, or whatever. You have to be very upfront about that, and the best way to do that is concrete, specific examples that are in the document as here are illustrative calculations of how this would work in real life.
The last bookend advice we'll give in this SBA plus situation and scenario for tuck-ins would be you have the ability to refinance whatever loan you have by sourcing new capital with your next acquisition.
Yes.
And so this is a really helpful strategy, solution. So you want to make sure your next acquisition is big enough to afford you a financing partner that allows you to recapitalize the favorable terms you might have already received from the SBA-backed lender.
Yeah, and you need to bear in mind also that depending on what that capital instrument is, you're also going to go through another round of diligence, another round of transaction costs. You have to be prepared for that. You have to make sure that the juice is to squeeze, right? So are you buying that? Is the SBA a Band-Aid to get you to your next deal? Because you've kneecapped your legal entity or your legal org structure in such a way that you can't get a deal done without refining the SBA. You need to think about those things. It's important to think about how your capital limits your flexibility. To Tristan's point, right? You need to understand if your structure locks up your cash flow, if your structure constrains your options, if your structure prevents you from doing that next acquisition, you broke your platform, right? And that doesn't mean you can't restructure it or refinance out of it. But I will say this, as somebody who did corporate restructuring and turnaround for years, those conversations are decidedly less enjoyable than the conversations when you're buying somebody, right? It's about how are we going to agree on taking less to get this thing to work the way we want? I think I mentioned previously, the old joke is that a successful restructuring closing dinner is the banker, the lawyer, and no clients. That's not a joke. That is, I mean, it is a joke, but it's also, frankly,
Fact.
it's factual.
Yeah. We have another question from the group, which was Sam and Link both brought up, how do you get a seller comfortable with this creative financing deal structure? Because this is where like the deal falls apart for them, not because they haven't thought of the creative financing approach, but because the seller didn't understand it.
Well, I think that's a persistent problem. In general, I think that people often don't understand the capital structure, the capital they're taking. And it's not just well, there's a couple of things here, right? I mean, sellers have a preference for cash because they know what cash is, right? It spends like cash. A seller note, they think, well, it's debatable, right? It's a debt instrument, but I feel like I still own the company. So oftentimes what you get is essentially like it's a loan with a backseat driver, right, on the business. So if you haven't structured it that way, and this is more into the buyer side or the seller psychology conversation we had previously, but beyond what they really want isn't cash per se, it's certainty, right? Cash just feels like the answer for how you get there.
Yeah, most of the time you're working against the market communications of investment bankers. The people who do exit planning, the people who are financially incentivized and reward for transactions to take people to market, try to throw shade, try to claim you're a bottom feeder. If you present these types of offers, you're not credible as a buyer. If you use these as your deal structures in the market, or if as a seller you accept them, you're being taken advantage of. And so that's the noise that is persistent online. And so a lot of founders just see that, and even if they don't interact with it, and they think, okay, well, I'm being taken advantage of. And there are instances where you have to be careful. You need to do reverse due diligence and understand who your buyers are and how they can run your business and what you're going to do with them moving forward. The vast majority of the time, it's just that you're working against the PR and the marketing of firms that are incentivized financially for transactions. And that's just not the case. The vast majority of the time, when you're buying a smaller business from a founder who is not a tire kicker, who is motivated for personal reasons or commercial reasons to sell the business, these are sometimes the only options available to them. And people go, well, why don't they just keep the business? It's not available for them to keep the business.
Yeah, I mean, the seller is done, right? Or they're ready to be done soon and they need to find liquidity. I know in previous podcasts you've talked about the so-called silver tsunami and, the coming wave of boomers and older edge Gen Xers who are coming up on, sort of end of career opportunity or need to sell their business. There's a ton of businesses in the marketplace, not just agencies, that need to change hands. And that is both great for a buyer because there's plenty of options out there. It's also, it should be more terrifying for a seller than it is. They're worried about value and legacy. But it also means that they can't be greedy if they want to get decent terms. The other thing is the more certainty you want, the less I'm willing to pay. Because essentially, we talked about this in previous recordings of this podcast, the more risk you want me to assume, the less I'm willing to pay for your business. If you're willing to take some of that performance risk, or if you're willing to roll forward into something bigger, right? And so you can have a second bite at the apple, a bigger exit, a build towards something else. If we structure it properly, we can produce a better outcome than an all cash deal, but they have to buy into that. Now, the other thing I would say from a psychology standpoint, two things, right? They do want the certainty and you do need to address that concern. But if at some point, if somebody is so rigid that they are not willing to get over their hump on cash or things that feel like cash, you have to treat that like a red flag because that person, if you even get them into a deal structure that is deferred consideration, as the business has any sort of performance ebbs and flows, they may not have governance, but they're going to have reporting, right? And as you disclose results to them, it's going to be potentially sniping from the cheap seats or somebody who is absolutely they're
Yeah.
focused on their own, on getting their own and not on supporting the business.
Yeah. Which I frame it a little bit more qualitative. And here's the suggestion I give to Lincoln Sam. The vast majority of the time, you're dealing with an unsophisticated seller, and your job is to educate the seller. You need to
Absolutely.
know the past, present, and future of the M&A opportunity, so the business buying and selling in your industry and in your space. When you know that information, you're able to present that to them, describing their future like you're reading a crystal ball. And the vast majority are thinking their business is worth more than it really is. There are plenty that do transact, are a good fit for the right strategic, the right private equity firm, but the vast majority of businesses are extremely difficult to transition in the small business, SME, small to mid-sized enterprise industry.
I mean, what
So
percentage on biz buy sell actually transact?
20%. Yeah, 80% of businesses listed for sale. These are going through a sale process actively, can't find a home. And so whenever your inventory has that level of success, business brokers have less than 50% success rate in their engagements. And so when you start factoring in the options available to these businesses, time is not in their favor. And so I'm not saying everyone should take a discount on their business. They need to take a real assessment of the value of that company relative to the buyers and the industry and the market, and calibrate their expectations accordingly. We all don't like losing a step as we get older, but it's when you assume you can do things that you used to do or that you can do that you shouldn't is how you get injured.
As somebody who's had multiple knee and ankle injuries in my later years, I can attest to this. At some point, you don't quite have the flexibility and you're not quite as spry as you were when you were younger. I think the other thing that is worth double tapping on is you mentioned that there's an entire ecosystem worth of advisors that give them advice that is not necessarily deal friendly. Now, let's keep in mind that this ecosystem of advisors has essentially produced a situation where you've got a 1 in 5 shot of successfully selling your business because the expectations that have been created for the other 4 out of 5 sellers for all intents and purposes have been dramatically warped by somebody who told them, get cash. You're worth this much. You've got to get this much. You've got to get these requirements. They create inflexible sellers. And it's important early on in a deal, if you're dealing with somebody like that sitting in on the shoulder of your seller, you need to figure out a way to discredit isn't necessarily the right term, but
Educate.
you need to dislodge that person as the only source of information or perspective and educate the seller to understand that's not how it works. This person has an
That's not the
incentive to
reality we're
tell you.
living in.
Right. And the other problem, of course, is that sometimes their compensation is tied to how much cash they get for you, right? Because
Now, Charlie Munger had a
they wrote their engagement letter in
yeah.
such a way
Charlie
that
Munger
they
has
got.
a really yeah. Charlie Munger has a wonderful line, which is, "Show me the incentive, and I'll show you the decision." And then he narrowed that in valuation, saying, tell me who paid for the valuation, and I'll tell you its bias." So at the end of the day, what we're trying to communicate to Sam and Link here, members in our community, is have a little bit of grace for sellers. When you have a rigid seller who is not providing evidence, who doesn't really have a grapple of the industry or the marketability of a business relative to its exit opportunities, have grace and educate them. Spend time, not a excessive amount, but sure, 30 minutes, 45 minutes teaching them the market. And if you don't know it, that's why you have to be in communities and say, what is the state of M&A within my industry right now? So then you can make that available to them. And then point to the bias that these brokers have and these industry folks who are incentivized by transactions, yet they don't have the conversion rates for it. And know the difference. Now, this is also sell side. When we switch seats and we're selling, we've already gone through and address the discount factors. We've already brought a business that is ready to transact to a buyer. And oftentimes that's not the case for sellers.
No, in fact, I would say that most sellers who come to market are decidedly unready to sell in terms of, I mean, in terms of the quality of the financial information they bring to you, their willingness or their readiness and ability to respond to diligence requests. Now, some are great, right? And those are people who understand their value and understand how to maximize it and may have taken Peter's course, may have talked to our friend Felix Velarde, who talked about addressing discount factors and valuation, may have
Maybe
done it.
working directly with you and evaluating the business performance relative to their expectations.
Yeah. And, I spend a lot of time focusing on setting, realistic financial goals and also working with my clients to improve the quality of their books and presentation so they understand what they're putting in front of a seller or a buyer rather, and how that communicates. As we said in a previous iteration of this conversation, everything is due diligence, right? And the way in which you bring your numbers to the buyer, how fast you are in responding, how you present them. Are you able to do so in an accrual fashion because you're actually thinking that you're going to sell to a sophisticated buyer who's ready to do that? All those things are diligence data points that impact the perception of a buyer has of the seller. And we do our best to optimize those on behalf of our clients in order to make sure they're putting their best foot forward to maximize their value in any transaction.
Yeah, we had another question that was kind of the same as Sam's, which was, and the question around addressing a seller, which is, how do I explain not using SBA to a seller? And my take on this is, don't position it as we're not using SBA. Position it as we're structuring this so the business performs well after the transaction with high probability. And we're not burdening it with aggressive or really inappropriate levels of debt. And then can make that contrast really clear. Like an SBA deal is a high debt load obligation day one on this company. Fixed payments, regardless of performance, more risk to the
It's
business
40,
continuity,
all of it.
all of
Yep.
it.
I
And
mean,
it's a leverage buyout, highly leveraged buyout.
yeah, I mean, our goal here is to create capital structure that has built-in shock absorbers, if you will, that are appropriately sized, appropriately governed, and create flexibility to account for the fact that once you buy the company, you need to survive the next 6 months,
Yep.
right? Because we've kind of glossed over this. I've made reference to it in previous conversations, but acquisition is a fundamental shock to the system for the acquired. It's also a shock for the acquirer. And I don't mean that in a way that should dissuade you from doing a deal, but you have to understand it's a big change for everybody. When some of the social factors you talk about in your course about how you reach out to people, how you touch base with them, all of the things that help them feel comfortable, those things all, while your job is to lessen the shock, They have operational impact, right? Some clients say, you know what, I'm out of here. I was thinking about changing providers anyway. Others, yeah, maybe they come over, but they don't renew. Or maybe there's a big headache because, they were paying using this system and you can't get them to pay over. So your cash working capital blows up because all of a sudden you got twice as many receivables as you budgeted for. It's all about surviving the first 6 months until the business sort of equilibrates and you reach, a go forward steady state.
Yeah. The
And if you can't
SBA
do that,
optimizes.
right, the SBA loan is the best way to run face first into that wall.
Yeah, the SBA optimizes for closing. Structure optimizes for outcome. And what Peter and I are trying to triple emphasize in this creative financing series here is the capital stack and the creativity you can apply to it optimizes for the outcome and value creation given the risk and uncertainty of the future.
Absolutely. Over-engineered capital doesn't necessarily reduce risk unless it addresses the key variables you're trying to solve, right?
Yeah. The other question is, okay, well, where does conventional bank debt fit? And I always considered it working when you have scale. So typically over $1 million of EBITDA consistently. You have diversified revenue, a strong leadership team, so less founder reliance. And so think of platform recapitalizations, refinancing an SBA out later, and supporting larger acquisitions. What are some of the limitations? What are some of the things that people need to know about conventional debt?
Well, it's like an SBA loan, only tighter, candidly. It is. I think if we take a moment to think about, I've actually been working on a little bit of a think piece to talk about how these things all interact and to compare them, kind of create a decision tree. But SBA loans are functional. Bank debt, I would characterize as cheaper capital and higher standards, right? It's lower cost than most alternatives, usually. It's fewer equity dynamics, and it's clean path to ownership. But here's the trade-off. Banks want predictability. And while bank debt may look like the most attractive option on paper because it's cheaper, it tends to work best when you have consistent cash flow, not just good months and a bunch of seasonality. You have very clean monthly reporting. You have defensible margins. You have a story that underwrites without heroics, right? It's great if you have a platform that's already strong and repeatable and you've shown that you can do it. If you need capital to cover integration uncertainty, bank debt can become a constraint, right? Bank debt's cheap for a reason. It rewards certainty. You don't have certainty if it's your first acquisition. You don't even have certainty if it's like your third. You have to have a strong, repeatable platform with a history of performance that the bank is going to underwrite to. And when it comes to sort of underwriting decisions, I think it's important to understand how banks actually underwrite agencies, right? When I hear an agency founder say we should be able to get bank financing, sometimes they're right. Sometimes they're missing what banks actually care about, right? So here's what banks like about agencies and what they don't, right? They like recurring retainers. They like diversified client bases. They like long tenured relationships. They like experienced leadership and they like stable historical cash flow because banks lend against predictability and certainty, not potential. That's where things get tricky though, because what banks underwrite first in order is cash flow durability. That's not last year's EBITDA. That's not pro forma synergies. They ask how repeatable is revenue. They ask how lumpy is cash flow. How dependent is the business on a few clients or a few employees or people, the founder, right? If cash flow durability is questionable, their willingness to underwrite leverage multiples drops fast. They look to reporting quality. Banks don't finance hope. They look for clean monthly financials. They look for consistent close timelines. They look for understandable margin drivers and forecasting discipline, not hockey sticks, right? Which means you need to show performance over time of your actual budgeting and forecasting. Your FP&A function has to be established and good, right? Execution risk means lower leverage or no financing, right? If your reporting is consistent or inconsistent, if it's late, if it's repeatedly corrected, banks assume execution risk and that you don't really have mastery of your numbers, right? And then here's the other thing that they won't necessarily say to you. They reward management depth. They ask, is leadership concentrated in one founder Who owns the client relationships? Can the agency absorb integration distraction? Are you big enough to do that and have your key people distracted for 6 months while you integrate? If the business can't run without the founder acting as a hero, banks price that risk accordingly. And, things that don't get the weight that you get from a founder, or sorry, that a founder gives to it. As founder thinks about this as a positive, banks don't, right? Projected growth. You cannot ever use the phrase, we will clean this up post-close. You cannot talk about cost savings from integration. Banks want to see. They don't want you to tell them, they want you to show them. And any sort of cultural fit narratives. Like that is all window dressing that does not really move the needle for an underwriter, right? They lend against what's already there and what they believe will continue to exist post-deal. They don't lend on potential or hope. Is that up?
And that's the same approach you should have as a buyer
Absolutely.
when you're trying to mitigate the uncertainty of your payment consideration to a seller. If your deal only works if everything goes right, it's a bad structure.
Yes, as a general rule, if your deal assumes like optimal outcome, it's not a deal. It's wish casting, right? And it's also important. While SBA is tight, bank debt is the least forgiving exactly when you need flexibility the most. I mean, the old joke is the only time a bank is willing to lend me money is when I don't need it, right? Bank debt assumes stability. Acquisitions and integrations create volatility, right? You need to make
And so
sure when you get bank debt, you don't maximize your leverage. Don't take more than you need. Don't just put a bunch of money to the side, right? Create flexibility. You got to buy breathing room. That is what your capital structure needs to
you
create.
got to buy free cash flow, not jerry-rigged EBITDA. And you also need to remember everything that we've just said about the risks in getting debt are part of the story when you're talking to a seller about why you want them to hold the debt instead. Again, you have to choose who you want as stakeholders in the future venture, and having people who understand the commercial side of the business and the uncertainty ahead of you make for really good partners
They've
and
lived
really
that.
good people to hold the paper.
They understand how the business works. And they've lived through the ups and the downs and understand the need. If they're reasonable people, they understand the need for that flexibility. And if they're not unreasonable about that, that tells you something too.
And I'll bookend it with, if you're only talking to a handful of people and they do not have this reasonable outlook on a potential deal, you're just not talking to enough people. There's more owners, not just the ones with silver hair, who will be open to seller finance, to less cash on close, and upside with you as a strategic owner, partner with ambition to grow. People want to be a part of high growth companies driven by visionary leaders. And if your goal is to grow out and aggregate, consolidate, solve problems with things that don't exist, that's a vision that will excite a lot of young founders who became accidental entrepreneurs.
Yeah, I mean, you're selling them on the next chapter of their story, right? What do we do next? Well, I had an exit of this business. I flipped part of it into this new business, and then I grew from there, right? While also taking money off the table. That's a great way for them to sell their own story, right? As they think about moving
100%.
forward.
Peter, any closing remarks on our creative financing? Sounds like we are anti-SBA in a lot of what we said, although we've
No, I
done
want to be clear.
SBA deals. Yeah.
The SBA is a great option, but you have to understand the pros and the cons, right? There are, and I think this is, before I get kind of a last point, I want to emphasize this. I like certain instruments because I think they create flexibility because I've seen the need for them and experienced them. That doesn't mean that I think that square peg always fits that round hole, right? It's as a deal maker, you need to be humble enough to understand that your favorite tool isn't the right tool all the time. Sometimes you got to bring out this piece of paper and use that instead, or you got to structure it this way. Sometimes an earnout is needed, right? And you can align with it. The most important thing is that your capital and your structure are done to solve specific problems, and you can answer why you're doing it, and you understand, and both parties understand the risk and the reward the put and the take and how all that works. Structured deals require trust, and trust only comes from clarity and alignment. It's important that both parties understand the instruments that are involved, that they agree that they are the right instruments to allocate the risk in the way the parties agree it should be allocated, that they feel that they are properly represented and protected from upside, if their upside is protected and their downside is mitigated in that situation. Without those things, without that trust, you don't get a deal. That's why people lean towards, we talked earlier about when people want cash, it's that they want certainty. Well, people will give up their certainty if they feel like they're being rewarded appropriately for it. And you can obviously subdivide the deal into component parts that give them, this much in cash and this much in seller note and this much in preferred equity and this much in earnout, or however you want to structure it, in ways that allow them to feel they're being fairly compensated for all those individual risks. So yeah, like I said, trust comes from clarity and alignment. It is important to be transparent, to do mathematical examples, to show this is what it looks like if we do it using this formula, right? There's
I think that's
nothing.
a wonderful. I want to make that our closing statement. Do the math.
Yes, right in front of them.
Show them your math. Show them the model. Collaborate, don't negotiate. And the folks who do have a higher probability of closing. But Peter, I think that is a wonderful way to end our creative financing series. Any final thoughts?
Listen, it's been fun. I always enjoy having conversations about the best way to, customize an individual deal. I hope this is well received, and I would love to hear from anybody who's got questions or comments.
Yeah, let us know what capital stack is your favorite. And to Peter's point, don't just use your favorite. Come to a deal with the right calibration to the risk, and let us know in the comments what series, if you like this format, we can provide as a resource for you moving forward. As always, Peter, thank you for your expertise and wisdom.
My pleasure, Peter. Take care.
If you like this episode, probably like one of our other episodes, click here.